It's time for our last presentation of the day, the impact of the new lease standard. And we have Brown Edwards' own Matt Heatwole, partner. He is based in the Harrisonburg office and serves a variety of clients specializing in audits and other assurance services for local governments, construction entities, cooperatives, and not-for-profits, of course, including foundations. He also assists a variety of small businesses and individuals with tax compliance. Matt has industry expertise in the areas of construction, cooperatives, not-for-profit, state and local government, and taxation with a focus on local government audits, single audits, and annual report preparation. Thank you, Matt, for offering to do this for us today, and we look forward to your presentation.
Okay, thank you, Melissa, and glad to be here presenting today. You know, it's at the end of the day. We've heard on a lot of different topics, and I feel blessed to go last because I think the last topic of the day is going to be the most fresh in your mind, right? So leases, you can go home to your significant others and talk about leases this evening because it's going to be so fresh. But nonetheless, let's jump into it, and we'll see how it goes. So learning objectives for this session. We're going to identify the main provisions of the new lease standard as contrasted with prior accounting requirements, identify financial statement presentations, disclosures required by the new lease standard, and look at the operational impact of the standard. It's a pretty significant standard. The FASB document is actually 191 pages long, which is more than the revenue recognition standard. I was surprised to see that because in my mind, the revenue recognition standard was much more complicated as this one, but nonetheless, it's a big one. We've been talking about it coming for a number of years, and I think it was the title of my presentation saying it's here is a good way to think about the lease standard because we've been talking about it a long time. This presentation today is only an hour long. We have done some internal trainings on leases that were 3 hours long, and honestly, with all the information that's included in this standard, you could probably do an 8-hour session. So topics today aren't going to cover a lot of provisions in the standard like modifications, remeasurements, sale, leaseback transactions, subleases. There's also not going to be a lot of discussion today on what I have regarding lessors. The changes for lessors isn't near as impactful as lessees and so forth. Also, the focus today is on the FASB side of things. I know we have some governmental entities attending. I've actually talked about the GASB side of this standard on some previous symposiums and trainings we've done as a part of our governmental conference, and we'll probably talk about it again when we do that in the spring. So that one's coming on the governmental side, but again, today we're focused on the FASB side and private companies. So at a high level, what is the new standard, and maybe more importantly, when does it actually have to be implemented? This is Accounting Standards Update, ASU 2016-02. It was issued back in February of 2016. It's codification topic 842. It is effective for privately held companies with fiscal years beginning after December 15th, 2021 of this year. So if you're a calendar year entity, December 31st year end, it is going to be effective for 2022. If you're a June 30th year end, it's actually not going to be effective until year ending June 30th, 2023. So you have some time for both of these. Of course, early implementation is permitted, but it was delayed as a part of the pandemic and COVID impacts and so forth. But really, I think today we wanted to go over this standard at a high level, look at some examples, and really get people to start thinking about it because it's going to take some effort on the front end to make sure everything is recorded correctly. What is the goal of the new standard? I thought this quote was pretty funny. And looking through my slides, I realized I don't have many pictures, which is typically standard in mine because of I feel like I'm always covering FASB updates or GASB updates. So again, I apologize for the lack of pictures, but here's an airplane for you and a pretty good quote. regarding the goal of the new standard. It's from Sir David Tweedy, the former chairman of the International Accounting Standards Board. It says, "One of my great ambitions before I die is to fly, or I assume fly in, an aircraft that is actually on the airline's balance sheet." So what does that mean? That means in the past, these assets that we were using may not necessarily be reflected on the balance sheet, and liabilities related to those assets, related to these leases, may also have not been on our balance sheet. So we're going back to, what is the definition of an asset? What is the definition of a liability? An asset is something that we're going to obtain future benefits from. And with these leases, we always knew we had, specifically these operating leases, we knew we had an obligation going forward regarding future payments, future obligations, yet those weren't necessarily recorded as a liability on our balance sheet. So that's the goal of this standard in a nutshell. We want to get assets on the balance sheet related to these leases. We want to get liabilities on the balance sheet related to these leases as well. What does this generally mean? What does this lease standard mean? A lease will exist in an agreement or a contract specifically, where an entity has a right to control an identified asset. We're going to have the right to the economic benefits from using that asset. We're also going to have the right to direct the use of that asset. In the standard itself, there's a lot of discussion, a lot of examples of what the economic benefits from use of an asset are. Lots of definitions, like I said, examples and so forth. It's a lot deeper than these simple definitions here. Directing the use as well, what does that mean exactly? There's some examples, not getting into a lot of it here, but it does go a little deeper than these simple definitions. All leases with the term greater than 12 months are going to have to be presented on our balance sheet. There are a few exceptions to this rule. Short-term leases being one, we'll talk about that. There are also some very specific exclusions from the standard on the FASB side, and that's in the lease guidance itself, 2016-02. Intangible assets being one of those, biological assets, inventories are another example, which are covered by other standards. We're going to have a leased asset, which is going to be referred to as a right of use, ROU asset on the balance sheet. And then we're going to have a liability as well, which we're going to refer to as a lease liability on our balance sheet. One term up here, and I'll use my nifty laser pointer, contract, you'll see is kind of a key term in the standard, and it is a change from the previous standards. But a contract can really be a written contract. It can be an oral contract. If you have a question of whether you truly have a contract or not, I think topic 606 addresses this a little bit, but a contract being something that's legally binding. So we may not have we may just have an oral agreement with a lease, but if it's legally binding, it probably is a true contract, a true lease that we have to consider under this standard. Why does this standard matter? Well, it's going to change the look of our financial statements a good bit. We have some updated disclosures that we're going to have to get into our notes to the financial statements. We're going to have to track these assets, these liabilities, as best we can, and it could be significant for a number of folks. There's going to be impacts to working capital. Of course, we're adding assets to the balance sheet. We're adding liabilities to the balance sheet. How that affects working capital. Working capital ratios could be impacted. If you have debt covenants, bonding limits could be affected based on how those assets and liabilities are classified. There may be an impact to buy versus lease type decisions. Maybe it's better to just buy all these assets straight up as opposed to leasing them over a number of time. Job costing, budgeting techniques could also be affected. If you, as an organization, have a number of operating leases out there as a lessee, this standard is going to impact you. That's going to, that's where we're going to see the biggest impact. If you already have a lot of capital leases on your books, not quite the impact as somebody who just has operating leases. Okay, so let's let's get into it a little bit. Under the standard, we have a couple different things regarding lease classifications. First thing we need to do, though, is really define what a lease is. And I've got both the old standard up here and the new standard definition. So under the old standard, a lease was an agreement conveying the right to use property, plant, or equipment, like land or depreciable assets, usually for a stated period of time. So pretty standard definition, a little bit vague in some areas. Under the new lease standard, we have a contract or part of a contract that conveys the right to control the use of an identified property, plant, or equipment, a specific identified asset for a period of time in exchange for consideration. So a couple of key things to point out here in this definition. The new definition does specifically refer to a contract and includes the mention that a lease can be viewed as part of a contract as well. The definition also highlights the right to control within the context of a lease. And we have this line at the bottom called in exchange for consideration. So I think of that as if we have leases out there that are for $1 for the use of equipment, that probably doesn't meet the definition of an exchange-like transaction in this regard, and we may not have to apply the lease standard for something like that. But in summary, when you're looking at this definition, the old critical determination with leases was whether or not we had that capital lease classification or that operating lease classification. Under the new standard, the critical determination is really going to be whether or not that contract we have, part of a contract, written or oral, contains a lease. So those are really the two big differences in this new standard. We're going to have two types of leases under this standard, similar to what we've had in the past. This is different from governmental accounting standards, I might add, but under the new standard here, we're going to have what's called a finance lease, similar to what capital leases used to be. We're also going to keep the term operating leases. A finance lease, again, formerly referred to as a capital lease, are going to be leases where the lessee effectively owns the asset by the end of the lease term. Operating assets are going to, operating leases are going to be ones where the asset itself is going to revert back to the lessor at the end of the lease term. One of the main differences, again, both finance leases and operating leases are going to have to be on the balance sheet, where in the past, of course, operating assets, operating liability, lease liabilities, and so forth were not on the balance sheet. I did want to mention here lessors. If you're a lessor, you will still have and classify leases as operating, sales type, and finance type leases. You're to continue to recognize the underlying assets if you have operating leases. If you have those sales type or finance type leases, you're still going to continue to recognize that net investment in the lease going forward. Again, not a ton of changes for lessors under the standard, but wanted to mention that. So we're trying to figure out whether we have a finance lease or an operating lease. So we do, it's nice of the standard setters to give us some criteria here. We have these bullet points. A lease is going to be a finance lease if we have one of the following attributes being that a finance lease would be a lease which the ownership of that asset transfers at the end. It could be a purchase option, which is reasonably certain to be exercised by the lessee. That is a little different than the language, if you recall before. A bargain purchase option was the previous language. It could be a finance lease if the lease term is a major part of the remaining economic life of the asset. If the present value of our expected lease payments equals or exceeds substantially all of the fair value of the asset at the time of inception, that would be what we termed a finance lease. And then a new one here is this one: the underlying asset is so specialized in nature that only the lessee can use it. So 5 bullet points to consider when we're trying to classify these things as either operating or finance. If it doesn't meet any of these, the lease is going to be classified as an operating lease. So that bullet point here of a purchase option, which is reasonably certain to be exercised, I wanted to expand on that one a little bit. So question being, how do we determine if a purchase option is reasonably certain to be exercised? FASB tells us that analysis shouldn't be based solely on our intentions, what we've done in the past, or estimates of what we may do. It really should be based on economic incentives to renew. If we have penalty provisions for not renewing, if those are so great that it deters us from doing that, we probably need to say, well, yeah, we do plan to purchase this thing. If we're leasing a location that's unique to us, it wouldn't make economic sense to not purchase that asset at the end if that's a part of the deal. But really, again, what the takeaway here is the economic reasons should be the main focus when determining if we want to exercise that purchase option. And we'll look at a few examples of that a little bit later on. In the standard, again, the language about will we have this asset, will we be able to use this asset over the major part of the remaining economic life, and that's substantially all of the fair value attributes, bullet points, and so forth. But it's no longer that bright line test of capital asset or capital leases that we were accustomed to. But FASB says, well, we're not going to tell you that exactly, but you can use this criteria to determine that. If we believe that we're going to be using that asset for over 75% of the useful life of that asset, then that's kind of the cutoff for those. And again, that 90% test of the present value of the future payments compared to the fair value of the asset at that time. If we're meeting that criteria, FASB says yes, that probably meets the classification of a finance lease in that regard. So this is just a visual summary of some of the changes on both the standards. Again, types of leases, we've still got two types compared to the old. We've got operating capital, now we've got operating finance. And again, the criteria listed here, transfer of ownership is still a thing. The purchase option likely to exercise versus that bargain purchase option language. The lease term being greater than the major life of the asset, or a major part of the asset life, I'm sorry. The present value of payments attribute, and then that specialized asset attribute. So again, if we're meeting any of these criteria here, we need to show it as a finance lease and account for it. Wanted to talk a little bit about short-term leases, because short-term leases, if we're classifying and find leases to be less than 12 months, then we're going to continue to basically account for those as operating leases. You can elect an accounting policy. I would adopt an accounting policy regarding short-term leases. Has to be applied consistently over similar leases and should be disclosed in the financial statements. But similar to the way we've been recognizing operating leases, we need to recognize that lease expense on a straight line basis. And renewal options do come into play in regards to this. If there are renewal options, and that does require us as lessees, and probably needs to be discussed with the lessor at commencement of the lease, whether or not those are going to be exercised. If we're reasonably certain that we're going to exercise those, then we really should be including these in that initial calculation of the lease liability. And again, FASB tells us when we're trying to make the decision to renew or terminate can also come into play. If we're making that decision to renew, it should be an economic decision. Again, if we're leasing an asset that's absolutely critical to our operations, to our business, if we did not renew that lease and our business would go under, that's an economic decision. So very likely we would renew and continue to renew. Again, I used the example of moving locations could be detrimental to our business. If we're very certain that we're not going to do that, then we need to include that in that renewal, that likely renewal in our calculations for these leases. with that, I didn't actually make polling questions, but I do think we have some attendance checks to get in now. And here's the first one.
We do. And so the numbers are a little bit out of order, but this one is just to confirm your attendance. So please just click I am in attendance and submit that. And we will give it about 30 seconds before everybody's rolling in on this one. So I'm going to close out here in just a few. I think we've slowed down. Okay, I'm going to go ahead and close it. Everybody was on point with that one.
Good job, everyone. No stragglers. That's
questions
good.
Yet either, Matt. So I think
What's that?
I don't have any questions coming through either.
Okay. Okay, so let's, for all you accountants out there, this is really the exciting part. I think we're going to get into some specific examples on how to account for these things on the balance sheet. So we've gone over the theory, some of the definitions. So let's get into the accounting for these leases. So the first step in this is we need to come up with our lease liability. We do that before going to the asset. So the lease liability is going to consist of the present value of minimum lease payments over the lease term. Within that definition, within that guidance, we need to figure out a couple things, right? We need to figure out the lease term. What is it exactly? We need to determine the lease payments. Both the term and the lease payments can get a little complicated. We need to figure out a discount rate to use because, again, we're bringing back that value to the present day, those future expected payments. And then we need to factor in any purchase options too as a part of this. So again, we start with the lease liability first, and then we're going to do a couple things to actually book that, that right of use asset too. And again, in these examples, in these accounting examples, we're only really looking at the lessee side because those are the most significant changes for people and probably will be. Couple things here. So again, we're looking at the lease term and trying to figure out the lease liability. The term is going to consist of the non-cancelable lease period plus any renewal periods we expect to extend. Again, those have to be economically, they have to economically make sense for us. So we would add those to our lease term, our non-cancelable lease term, and then any options to extend that are actually controlled by the lessor. That is a requirement in the standard. If the lessor is going to be able to control and extend these leases, we have to factor that into our term as well. So that's looking at the term. The next piece here is actually the lease payments, which can get a little bit complicated. But let's see, we've got our, hopefully, which identified our fixed lease payments, which we know about, minus any lease incentives we're going to receive as the lessee. And then we have this thing, any variable payments. But I did want to point out variable payments in this sense, there is some guidance here. If those variable payments are based on an index or rate, we do use the rate at the time of commencement when trying to figure out these variable payments. If that rate, like CPEA, changes in the future, we're not going to adjust that liability up and down each year. That change in the rate is going to affect our payment, of course, but that difference each year is just going to run through our income statement. Other variable payments, sometimes leases consist of revenues we've earned as a business for the month or something like that. In this initial calculation, we're not going to factor those in. They're just unknown, honestly, at this time. But as those changes come up in future periods, those are also simply going to run through the income statement in future years. Now, if we do have variable lease payments, we know are going to happen and are going to be pretty steady, or are in substance fixed payments, we can factor those in this calculation. Exercise price, probable residual value guarantees also need to be factored in to what our actual lease payments are.
Hey, Matt, we have a question I thought I'd go ahead and relay to you.
Okay.
This is from Catherine. Is the exclusion to not capitalize less than 12 months, or is it 12 months plus? For example, what if the lease is equal to 12 months or 1 year?
I think it's 12 months or less. You would not have to capitalize.
Okay.
Is the way I have read the standard.
Okay.
So
Thank
12
you.
months and 1 day probably would have to in that regard.
Okay, that's all I had.
Okay. Another piece in figuring out the liability is our discount rate, what discount rate to use. If you have a lease that does talk about a rate to actually apply to this, that'd be great. If you do not have that, it would be the lessee's incremental borrowing rate. That definition is here. It's basically the rate of interest that a lessee would have to pay to borrow on a collateralized basis over a similar term on an amount equal to the lease payments in a similar economic environment. So I take that as being, if we go out, if we were to finance an asset like this with our local bank, what is that rate going to be? That would be the rate we would use. There is a practical expedient for private companies. You are allowed to use what's called the risk-free discount rate, normally the federal funds rate, which is actually very low at this time. That does have to be applied consistently for all leases. But one thing to remember, if you're using a very low discount rate, that is going to increase that initial liability and the asset on your balance sheet. So something to keep in mind. So we figured out what are the inputs to our initial lease liability. We've calculated our lease liability based on those future expected payments, the discount rate, the terms, et cetera. So to figure out the asset side, we take that liability and then we're going to add any payments we've made at or before lease commencement, less any incentives we've actually received. If we had any initial direct costs incurred as a part of getting this lease together, those are also added to the initial lease amount. And there are some pretty good examples here of what that might be. Certain substantive incentive-based commissions, lease documentation preparation costs, legal fees that are contingent on successful execution of the lease, payments to existing tenants we would have to make to get them to move out, for example, but also some excluded costs here. And you might have some legal fees for services prior to execution. That may be a more common one. Those would actually not go into the calculation of the lease asset. So we've talked about the initial accounting. We know what we need to book for the initial liability, the initial lease asset. As we go throughout the years, how are we going to account for these in subsequent accounting periods? If we have operating leases, we're actually only going to have one single line item expense on our income statement. It's going to be called lease expense. We're going to recognize that lease expense in a straight line manner over the lease term. The lease liability itself is going to be reduced as we pay on that lease over the interest method. So we're going to have to come up with amortization tables to track all of that. The right of use asset is going to be amortized over the lease term as well. The amortization each period, though, the way to calculate that, and we're looking at an example, is going to be the difference between our straight line expense minus the interest expense each period. And it might be a little easier to look at an example for that. But again, our income statement isn't going to have interest expense, amortization expense. It's really just going to be a lease expense on our P&Ls. For a finance lease, it is going to be different. The lease liability we've booked is going to be reduced using the interest method as well. Again, we're going to have principal payments, interest payments. We're going to have to recognize interest expense as we do this. The right of use asset is going to be amortized on a straight line basis. And a couple key points here. The amortization period of the right to use asset is usually going to be the shorter of the useful life of the asset or the lease term. If we know, though, at the end of this lease, the ownership is going to transfer, or we know we're going to purchase this asset at the end of the lease, we actually need to amortize it over the useful life of the asset. Because at the end of the lease term, we know we're going to use it a number of years after that, right? We're going to purchase it, we're going to use it. The useful life, again, needs to be the useful life of the asset as opposed to likely the shorter lease term. So an important point there. On our income statement, we are going to have two separate lines, one for interest expense and one for amortization expense. And those can be grouped in our normal interest expense line items, amortization expense line items. Those don't need to be separately broken out. Wanted to put this in. This is just kind of an overview, a visual overview of both finance and operating leases and how they're going to look on the balance sheets. I also have an example after this, but again, finance and operating leases both have pretty much the same balance sheet look, right of use asset, lease liability. The difference being on the income statement, we have amortization expense and interest expense for our finance leases. And we're going to have just a single lease expense line item on a straight line basis on our operating leases. Cash flow statement for finance leases, we're going to have, of course, principal we're paying down, interest payments, and the lease expense itself is going to be under the operating side on the cash flow statement. Again, kind of a summary here, the subsequent accounting. Not a lot of changes for operating leases on the P&L. We're going to recognize that straight line expense as we have been doing. Finance leases, we're going to have an interest and amortization expense separately on the P&L. Again, the primary changes here are going to be the balance sheet effect of these standards. So with that, let's look at a couple specific examples here that I think kind of tie all these in. This first example deals with just this initial measurement of the asset and the liability itself. So a couple of the facts here, we have a date of the lease of January 1st. The lease actually commences on February 1st. The lease is for a term of 10 years. We have $10,000 per month in payments. The first month rent is paid at the execution of the lease. We're going to incur some initial direct costs on February 1st that we know about. We're also due to receive some lease incentives of $50,000. Gone ahead and calculated the present value of the lease payments based on either our incremental borrowing rate or the discount rate in the lease. That calculation comes out to $900,000. So let's see, how does that look? Our initial lease liability, again, is the present value of those expected payments, $900,000. The asset itself is a little bit more complicated, but again, we're starting with that initial lease liability. We've got our initial payment at the beginning of $10,000, so we add that in. We're due and assume we've received those lease incentives of $50,000. That's a subtraction. And like I said, we've incurred some of those initial direct costs. So we have an initial right of use asset of $861,000 compared to an initial lease liability of $900,000. So I think that's a good example of the liability isn't always going to equal the right of use asset. So for all of you who had thought, well, our impact to equity, our impact to net assets isn't going to be material. It could be, I mean, depending on the lease itself, but something to keep in mind. This example here, this is the subsequent measurement of a lease, and unfortunately it doesn't mirror our initial measurement example, but it is, I think, a good example to look at. So in this lease, we've got commencement of January 1st. The lease term is for 3 years. There are no expected renewals in that. The life of the underlying asset is 6 years. We're due to pay $500 a month at the beginning of the period. So again, no initial direct costs, no incentives. So in this case, the initial asset and the liability are actually the same at $16,518. So how is that going to look? Again, the liability is up here, $16,518, and the asset, $16,518. With an operating lease, we are recognizing that straight line expense over the period of payments. So payment in year one of $6,000, we do have what's coined an interest piece of that, like I said, because we're paying down our lease liability. There's a principal piece of that. There's an interest piece of that, but The difference in that payment and our interest expense is what we're going to recognize as amortization expense each year. So pretty good, pretty easy example, I would say, of the subsequent measurement of operating leases. Okay, so a little more involved here. We've got a finance lease example. So I want to point out a couple things. The term of this lease is 5 years. The life of the underlying asset is 6 years. There are no specific purchase options in the lease. We've got annual lease payments of $1,100 due on January 1st of each year. We figured out our incremental borrowing rate is 7%. We know the fair value of the equipment we're going to lease is $5,000 with no residual value. We've also calculated the present value of the 4 lease payments after the commencement date to be $3,725. So let's look at this. Why is this one considered a finance lease? Well, we're going to be leasing this asset for 5 years, 5 of the 6 years of its economic life. That ratio is 83%. So we've already met that one of those criteria of leasing the asset over 75%. We're at 83% with this calculation. The present value of the lease payments, which we'll show you on the next page, actually comes out to the $3,725 plus the $1,100 we pay on the first day of the lease commencement. So the present value of our expected payments come out to $4,825. $4,825 divided by 5,000, the fair value of the equipment is actually 97%. So we've actually met that piece, that attribute of the finance lease consideration as well. Our initial lease liability, again, is the present value of those 4 payments using a discount rate. The initial right of use asset is the lease liability plus that first month's rent of $1,100. The journal entry for this is to book the asset here, the offsetting lease liability, and again, we've paid cash out for the first year's rent of $1,100. So here's kind of a visual representation of how the accounting for this is going to look on the lease liability side. We've got our initial lease liability of $3,725. Again, in year 1, we've already paid down that $1,100, so we don't have an actual payment there, but we do have interest expense to recognize in that first year. Going into year 2, we know we have to pay $1,100. A piece of that, based on an amortization schedule, is $839. Interest paid is $261, but the expense recognized is $202,000. So ultimately, we get down to our payments, principal paid, paying off the debt, and we do have some interest expense to recognize throughout that time. The right of use asset, again, we know we're not going to purchase this asset, so we want to do a straight line amortization over the term of the lease, which is 5 years, so $965 a year for the 5 years. I thought this chart was interesting, kind of neat to see the effect of operating leases versus finance type leases. And how it all works. At the end of the day, after 5 years of payments, we do get down to the same expense, right? $5,500 on the lease on the finance side, $5,500 on the operating lease side. It's just on the finance side, we have this interest component that we're recognizing each year. So we're front loading expenses on the finance side to begin, but after a number of years, it flips where the operating side is actually recognizing a higher expense because we're, again, on the operating side, we're just recognizing the lease expense in a straight line manner over the lease term. But again, at the end of the day, at the end of the lease, we do get to the same actual expenses being recognized. This is just a visual chart showing that. Again, finance leases more front-loaded on the expense side, operating being very consistent over the term of the lease. Okay, time for another attendance check, I believe.
Okay, I've launched another attendance check. We'll see how fast we get these votes in. I'll also check for questions. So if anybody's had any questions so far on leases, please put those in the question panel, or if you want to raise your hand, I'll open up your mic. Okay, we've got a high percentage, so I'm going to close this poll. Thank you, everyone, for getting your votes in quickly. And I don't have any more questions coming through yet, Matt.
All right. Also wanted to include in these slides what we've termed a comprehensive lease example, and you know it's comprehensive because of the number of bullet points here, so that's pretty clear. In this circumstance, we're looking at a lease that is 10 years, the term is 10 years, with five-year renewal options, so potentially, 35 years for this lease term. The economic life of the underlying asset is 40 years, so we're probably looking at a building in this case, I would guess. The fair value of that asset right now is $5 million. Key thing here, we have a purchase option of $3 million at the end of the initial term. So at the end of these first 10 years, we can actually purchase this asset for $3 million. As the lessee, and I'll tell you the answer. We've determined this is a pretty good move on our part, and you know, if we're looking at the fair value of an asset now that's $5 million, if we can purchase it for $3 million at the end of the initial term, assuming the fair value of this asset goes up, that's probably a good economic decision on our part. So that's a clue here on what type of lease this is. We have expected payments of $500,000 per year due at the beginning of the year, which increased 3% annually. There are some incentives built in. Those are going to be payable at the beginning of year 2. Our discount rate is 9.04%, pretty high, but that's the rate that's in the lease, or that's our borrowing rate as of today. Title doesn't actually transfer at the end of the lease. There are no residual value guarantees, and the asset is non-specialized in nature. So the way we've structured this is a couple questions for everyone. You know, is this lease an operating lease or a finance lease? Again, knowing the purchase price being $3 million and the fair value of the asset is $5 million right now, it's reasonably certain that we're going to exercise that purchase price at the end. It makes economic sense. What is the lease term? Again, we have a term of 10 years, but we're very certain that we're going to purchase this asset at the end of the term, which is 10 years. So our actual lease term in that case is the initial term, the 10 years, prior period to the purchase option. What payments do we have to think about when measuring the liability and the asset? Well, we've got the $500,000 rent payments we know of. The purchase option is actually part of this calculation. The $3 million purchase option at the end factors in. $200,000 of lease incentives also has to factor in. What is the annual amortization expense? As I talked about a number of slides ago, due to the fact we know we're going to purchase this asset at the end, we need to use the expected useful life of the asset, which was the 40 years. So we're going to have the $5 million divided by, comes out to $125,000 a year, 5 million divided by 40 years. One key point here when we're looking at the present value of our expected payments, it's really two different calculations that need to be added together. The $500,000 annual rent payments less the $200,000 lease incentive. That's one calculation that we need to present value back. And then a separate calculation is actually the expected $3 million payment at the end. We also need to present value that back to the present day. We add those two together and we actually get to our present value, the liability calculation. So how does this look once we get there? The liability calculation, like I said, is the $5 million, but we've paid $500,000 up front in year 1. We're going to recognize interest expense for the 10 years. We're going to reduce the liability as we make these payments. Again, we've got the lease incentives here in year 2. We've got escalating payments. I think it's at 3% annually, which is why there's an increase. But if you notice, as we're paying debt down, as we're paying our lease liability down, at the end of year 10, we have that liability of $3 million that we're going to purchase it for. So that's how the accounting works in that regard. The amortization expense is again based on the right of use asset over the useful life of the asset. So at the end of 10 years, we do have a value in that asset, $3.75 million. I will say at that time, at the end of year 10, when we actually purchase this asset, that right of use asset does need to be reclassified to a regular property, plant, equipment at that time. And then we'll continue actually depreciating that asset over the remaining useful life. I guess at that time, it's going to be another 30 years. Okay, so lots of examples on the lessee side, not too much on the lessor side. If you have any real specific questions, if you're an organization with a lot of leases, you're the lessor in those scenarios, let me know. I can send you some documentation, but again, mainly still focusing on the lessee side. All right, lease presentation and disclosures. Again, on our balance sheet, we're going to need to present separately or within similar classes of assets and liabilities. We're not going to be able to commingle finance and operating leases. And it's probably best to look at an example here, and hopefully everybody can see this, but on our balance sheet, we're going to have right to use assets for our operating leases, right of use assets for our financing leases, and then liabilities for those as well, separately stated. In this example, you are allowed to present, in this case, it's finance leases that are grouped with other assets. You are allowed to do that. You know, maybe this organization made the decision that the finance leases aren't very material. We're going to group those in here. So we would need a supplemental disclosure discussing that. What you're not allowed to do is like the previous slide said, commingle both finance leases and operating leases in the same line. Again, on the statement of cash flows for operating activities, basically the operating section is going to have our lease expense reflected there. For financing leases, we are going to show the principal payments, and the interest payments are going to be up in the operating section. There are a number of new disclosures, especially if you have a number of operating leases. We need to talk about the contractual details of these leases, any contingent rentals, options, any significant judgments that were made when booking these things. We're going to need a maturity analysis of the undiscounted lease payments, a 5-year maturity schedule, which we already have for debt payments. We've had those for capital lease payments as well. We're just going to need those for operating leases too. So again, the bigger impact here is going to be for these operating leases. Implementation guidance, so transition, you have a couple of options on how to get these on your books, on your financial statements when we're starting out. You can, really what the guidance tells you, it's called the modified retrospective method. We're going to recognize the asset and the liability as of the earliest comparative period presented. So we're going to, if we're in the middle of a lease, for example, that's 10 years and we're in year 5, we're going to calculate the asset and liability based on the expected next 5 years of those payments. So you don't have to go back to year 1 and do calculations and figure out, well, what's our beginning impact of retained earnings, beginning net assets. You can do that, and that's what this alternative transition method talks about, but I'm sure most of us are going to figure out the asset and liability as of the earliest date we present in our financial statements. There are a couple practical expedients in the standard, which are nice. You do have to elect all of these as a package. An entity is not required to at transition to reassess whether a contract is a lease. This is a good thing, you know, whether a contract is a lease or not. I don't think we have to go back and pull every single contract we've entered into or what's existing at this time and determine if there are leases in there. I will say you need to exercise some caution with that, because if you do that and when we realize that, you know, these contracts did have lease components in them and we haven't been accounting for them correctly, we really should get that corrected going forward. So just because we have this expedient, you don't want to carry forward incorrect accounting of anything. Another expedient out there is the classification criteria. Again, we're going to have operating or finance leases going forward. If we've had operating and capital leases on our books right now, you can continue with that criteria. Of course, capital being switched to finance for the existing ones and continue to account for those. This way, you don't have to do another analysis, another judgment decision on operating versus finance. So that's nice. We don't have to go back and figure out all the initial direct costs we may have had with those leases, so don't need to worry about that. And so there is an implementation example here, a fact pattern. You all can read that on your own. It's not too complicated, but does give you some guidance on booking the asset as of the earliest period presented in the financial statements and the corresponding lease liability. Yeah, last attendance question for the day before we get to some implementation measures here.
Okay, here's your attendance poll. And we do have a question comment from Barry in here. Tax handling will be different from financial statement presentation.
Yeah, there are some tax implications here. I have not dealt and dived too deep into those, but expenses could be different, with this standard. So that's something that's going to factor in.
Okay, I closed the poll, so we should be good.
Okay, so last piece of information to cover here, kind of everybody's marching orders for the next year and a half, preparing for implementation. So some things we need to watch out for and prepare for. The biggest risk with this standard, in my opinion, is simply just figuring out what leases do we have out there. If you're a large, non-centralized organization, we need to worry about contracts that are out there, probably existing, but going forward too. What contracts out there contain lease terms? We need to be looking at contracts with what we call potential embedded leases. Those might consist of agreements that bundle a service and a device potentially. Service contracts in the standard itself, service contracts, I think you would think of as obligations that happen from time to time. You're going to need to distinguish leases versus those service contracts. In a lease, we really have a right to use an asset, whereas a service contract, it's basically going to be a supplier coming out, fulfilling some type of obligation, and that service is performed at the time. Leases also, we have these recurring fixed payments that we have to make, whereas a service contract, we probably only have to pay someone for that service as it happens. In looking at leases, we're going to need to separate both lease and non-lease components of a contract. Non-lease components can be really a number of things. Some of the examples in the standard talk about common area maintenance charges, security charges, if you're leasing a building, for example. Those type of non-lease components don't really contribute to the use of our asset of that building. So those are some things to look out for. What are the effects going to be on our key financial statement items, ratios, for example, working capital, debt to equity ratios, debt covenants could come up, and direct job cost allocations could be impacted by this standard. So stuff to look at. It may be worth considering separate tracking software when necessary. If you're an organization with a number of capital leases, operating leases, investing in software may be something to consider, a database of some sort. A lot of effort is going to have to be made at the beginning, though, to gather the data for that software, but it may be something to consider. Of course, making preliminary calculations of the assets and liabilities to determine the impact on your financial statements, talking with bankers, bonding agents about the impact of these, how does it affect covenants you may be subject to. liabilities in general are going to increase with this standard. So debt to equity ratios are probably going to be impacted. EBITDA on our income statement, the question of is lease expense equal to rent expense? Usually rent expense is included in those as lease expense as well. We're probably going to have some decreases in ratios like return on assets. Your current ratio calculations might also be affected depending on how the asset and the liability and maturity dates are all factor into it. So Price Waterhouse did a study, this is back from 2019, on some of the anticipated difficulties of the standard. And again, like I said, the completeness of our lease population was the chief worry among organizations, which I think makes sense. Identifying embedded leases was also up there as a chief concern. So I thought that data was interesting. Not so much processes, controls, implementation, but just figuring out what we have is going to be a challenge for all of us. So some action items to go out and do now. Go ahead and prepare an initial inventory of lease data. Talk to your, again, if you're a big, large, non-centralized operation, talking with folks, talking with your departments, talking with your managers. What's out there? What type of contracts do we have? You're going to need to implement processes, systems, controls to maintain the inventory of all of this lease data. There's also going to be some internal control considerations to think about. Who's going to review these new agreements? Who's going to review the accounting on these agreements? Who's going to approve them? And items like that. Of course, reviewing existing lease agreements, determining the accounting under the new rules, calculating the effects of the financial statements, talking to stakeholders, users of the financial statements. It may be banks, it may be your boards. Are they gonna question, wow, what's this huge new asset? What's this huge new liability? So preparing them for some of those major changes might be good to do that now. Updating accounting policy documents, going ahead and drafting new disclosure items if you're on the ball, going ahead and getting those written up, and really probably developing a plan and timeline to implement the new standard. I've heard of people kind of designated an internal lease champion, which is a great idea. The champion probably also needs to be the lease police. Following up with departments if need be, following up with the contract decision makers, and making sure everybody's thinking about this. But education in the entire organization, I think, is important because it is a pretty significant standard. Okay, I think that's all I have. So a very technical standard, a lot to it, but again, you've got your marching orders, so to speak.